Okay, so what we're looking at is this concept of fading an aggressive trend. Now, to sort of paint the picture for you, a lot of people, if they were to watch this video and not know me for some years, they would straight away sort of go and say, well, why would you fade an aggressive trend? What's the point of it? Why not just go with the trend? Okay, and the minute someone says that to me, it kind of shows me a lack of insight into what the markets are all about. The markets aren't necessarily about always being on an aggressive trend. Okay, the market's all about risk reward. They're all about opportunity. They're all about probability. Okay, so whenever you assess an opportunity, it doesn't matter whether you think it's a fade or a buy or a long or a short or a risk reward of 1-to-1 or 5-to-1. It's all really irrelevant. The only thing that matters at the end of the day is what are the probabilities of outcomes, or what is the likelihood that you're going to be able to take a winner. Okay, so forget for a moment that we have this thing called a strategy, and just think in terms of outcomes, think in terms of probabilities, think in terms of, okay, yeah, that makes sense in terms of a risk reward perspective. Okay, so the example we're going to look at is from the CL, like I said, the 26th of April. And where we're going to go with this is we're going to just outline the concept of fading an aggressive trend. So the first thing we have to do is outline what an aggressive trend is. Okay, it's very simple. An aggressive trend, it looks like a straight line, as you can see. There's a lack of overlap. Okay, and that's very important to understand. There's no real pullback here, so we can see very little, two-way trade, and very price directional. Now, coupled with that, we need to see a lot of volume. So we need to see sort of a crescendo of volume, a real, sort of accumulation of volume to the upside. But also we need to see volatility. Okay, so we need to see wider, rotations of price. In other words, if each one of these lines is, 5 minutes, 30 minutes, whatever you want to call it, we need to see sort of a real pickup in the range of prices over which we're trading, i.e., volatility. Okay, so this is how we identify an aggressive trend. It's something that's moving very aggressively in terms of price. Now, the important thing to understand with regards to fading an aggressive trend is get this out of your head that there's levels. Okay, there's no such things as levels. Okay, in an event when there's an aggressive trend, you've got to remember that the participants that are driving that emotion, that energy, they're not concerned about price. Okay, they don't particularly care where price is. All they care about is unwinding their positions, in the most efficient way possible, in the most effective way possible. Okay, and it's important you always differentiate between when price is moving in a manner that has less emotion or more emotion, because ultimately emotion dictates which price you get out at. Okay, if there's less emotion in the markets are more subdued, they're more sort of logical, they're more technical, they tend to work off certain levels. When there's emotion in the market, okay, there's far less levels. In fact, there's no levels. Okay, so that's the first thing. If you want to learn to fade in any aggressive trend, remember this. There's no level. You're not looking for a level or a specific price point. You're looking for a specific interaction. Okay, now timing's crucial. And this is also goes hand in glove with why we do away with the levels. The moment you have a level in mind, the moment you say, bang, I want to get in at 63.5 because that's where there was a previous support or a previous reaction or swing low, whatever you want to call it. The moment you do that, your timing goes out the door. Okay, that just disappears simply because you're not looking at the dynamic of what's happening in the market. You're looking at a specific level. Okay, so you've got no timing. You're just simply standing in the way. You're simply providing liquidity in front of a sort of a runaway train. Okay, so crucial. You have to get rid of the levels first. Let's cross that out. Get rid of it. Okay, no levels. If you have no levels, you'll focus on timing. Okay, you get the timing right, and you've got the opportunity to fade an aggressive trend. Okay, and like I said, the interaction is key. That's paramount. That's what we're looking at. That's what I'm going to show you, and I'm going to show you how to time this. Okay, I'm going to teach you how to time this, and hopefully you learn a little trick or two. Okay, so this is what we're looking at. That's the oil daily. We're looking at a big ass red candle. Okay, as you can see, they do come these really big days. How we identify this strategy is very simply get a nice, what we call an ATR. You should all be familiar with what that is. Get an ATR and go and identify all these big days. Okay, and then go and look at ultimately how you could fade on those big days. All right, now this is the conundrum. At some point in this day, we exceeded the average daily range by 2.5 times. Okay, so significant. By any volatility measure, by any Bollinger Band measure, it was completely oversold. Okay. Now the crux is the market can stay oversold longer than you can stay liquid. So you've got to remember that. So hence why, again, do away with the levels, do away with this. I'm going to start fading it when it's 2 times average. Do away with this approach of, being so precise and invite into it this concept of timing. Time the opportunity. Okay, so what we're looking to do is we're looking to wait for the market to ultimately give us some sort of a signaling that the impulse is done, the emotion is through. Okay, so how do you know when, if you've been nasty to your wife or your partner? How do you know when the emotion's through? Well, she stops crying. Okay, the minute she stops crying, she may still be a little bit emotional, but the climax is done. Similar kind of thing. We want to look for this market to stop crying. Okay, the minute we get that market to stop crying and it gets to that climatic move, that's when we hand the tissue over, and that's when we start to look to go against, the trend effectively. Now, again, for a lot of the people that say yes, but I don't want to fade a trend and I prefer to go with the flow and all that, fully respect that. Okay, but what I want to point out to you is that the bounce here is 90 prices. Okay, so you're getting a 90 price bounce in a space of, I think it was, what was the time frame? A couple of minutes. Okay, so we're talking about a relatively, fantastic opportunity in a sense where, you kind of, I think maybe 40 minutes, you're getting a 90 tick bounce. Okay, think of the numbers there, 40 or 90 tick bounce in 40 minutes, guys, with limited risk reward. Okay, that's why we take this play, because the numbers make sense. It doesn't matter whether we go with the trend or not. Okay, so how this play works, I'm going to get the oil market up for you. I'm going to show it to you. Like I said, we're looking for those tiers to dry up. Once those tiers dry up, that's our opportunity. Now, to give you a sort of a background, we've got to go a little bit earlier into the day, and I'm going to shoot across to around 10 o'clock. Okay, so I just want to get this up. Where are you? Okay, just bear with me for a sec, guys. I just need to get this up here. Okay, so we've got to look at the first sell-off and see how that first sell-off sort of turned itself around. Okay, and this came at 10:40 in the morning. Now we can very quickly see that nice aggressive impulse, very aggressive selling, good sort of 50-60 tick move, and market just dries out. Okay, how do we know it dries out? Well, very simply, each one of these rotations, okay, big wide rotation, lots of delta, lots of volume, market suddenly goes dead. Okay, notice the difference. Look at the difference in size between that rotation and these two. Okay, so one little bit of selling, and it's done. Now, it's not saying the market's long. It's not saying, that everyone's gotten long. All it's saying is that there was one bit of selling. The selling stopped. Okay, there was quite a bit of buying absorption. Otherwise, we would have gone lower on this volume. All right, but ultimately, this was our first sort of key point, the 63, 85s. Okay, market then slowly trendles up. What does it do? Low volume, no delta. Okay, so that selling impulse is still there. 63.41 still important. Okay, we still identify that seller at 64.30, and ultimately the market then starts to just grind higher. Okay, it's not buying, it's not bid, it's not bullish, just grinding. Okay, it's finding that seller again. Eventually finds that seller below that 64.31, and again, not aggressive selling, nothing really going on. Market just slowly drifts. Okay, we're sitting in between this sort of 63 74s and 64 30 area. All of a sudden, 1 o'clock comes again. What do we see? Notice that seller again. Okay, so if I zoom this out, it looks very similar to earlier. One big seller, rotation picks up, volume picks up. What do we see? Okay, no follow through, no continuation. So quite difficult actually. Trying to be short this wasn't particularly easy, because you kind of got that impulse move, you got the signaling, you got short, you went on sides a little bit, it felt good, it really felt like you were in for a win, and then suddenly it just starts to rotate the other way. Okay, so we move on again. Market comes all the way back up. Ding ding ding. Where do we test? 64.30. Okay, what did we say? We said that's where the seller came in at 10 o'clock in the morning. Okay, seller's still there. How do we know that? Because the moment we came up to that 64.30, right, we saw a little bit of two-way trade before we saw initiative. Now we know it's initiative simply because of the response we had there. Okay, narrow candle, narrow candle, narrow candle, narrow candle, aggressive selling, aggressive selling. Okay, so that's our key level. If you want to trade oil 64.30, if you get anywhere close there over the next couple of days, we shouldn't be getting above that. Okay, above 64.31, and we're going to get some serious stop out to the upside. Okay, so there's a good level in oil. Shouldn't be getting above that. Now, this is where the real key comes in. This is where the selling sort of ignites itself. Okay, 64.14. Market starts to sell off. Okay. This time, however, we start to hold the offer. We know that because of the series of lower highs. Lower high, lower, lower high, negative delta, flat delta, negative delta. So the delta starts to hold negative. Okay. Notice, one time framing. Okay, every one of these rotations we can't take out the previous high, and one time framing is a particularly good indication of a strong trend. Okay, now had you been short, yes, okay, you got rewarded. Tough to be short early in the day, eventually got rewarded for those shorts. Right? But at some point we started to look at this move and go, well, hang on a sec, we've just dropped 150, 160 ticks here in the space of 45 minutes. Okay, so at some point this move does become overextended. Now, how do we identify that point? Okay, remember what I said to you, rule number one, we don't care about levels. There are no levels. Okay, they're just random lines. I can put up 20 different pieces of lines here, it doesn't mean it's a level. Okay, so what we're looking at is timing. Now, the way to time an overextended market is to look for a climatic move. Look for those tiers, and suddenly they dry up. That's when you start to fade. Okay. Now, we know that climatic move comes simply when we have the widest 5-minute rotation of the day combined with the highest volume of the day. Okay, listen to carefully what I said. It's the highest volume of the day on a 5-minute rotation as well as one of the widest 5-minute rotation candles. Okay, and that's the climax, guys. That's your clue. Right? Why? Because we shouldn't be seeing climatic selling after a 170 tick move. We should be seeing climatic selling at the start of the move, which is what we saw. Okay, so we saw the bit of selling and we saw the bit of selling there. But we shouldn't be seeing it after 150 tick moves. And there is your clue. The moment you see that climax, that over-aggressiveness, those big crocodile tears, once the big crocodile tears come out, that's when you want to get ready to fade. Okay. So again, note, very important when you are fading an overextended move, right? The market's going to be volatile, so you have to learn to manage risk in this situation. Okay, what I would say is simply buying it on this candle. Ideally, what we're looking to do is be fading this candle, right? But you can't simply go put a stop below the low. Okay, sometimes what will happen is the market will maybe extend that by a few ticks, maybe extend it one last time. But in essence, the moment you get that climatic candle, that's when you want to start to be fading. Why? Because that's the point at which you're going to get maximum risk reward. Okay. Now, we can see obviously the market then sort of had an inside candle, slow rotation higher, but ultimately we eventually went all the way back up towards the 63.18. So a good 100, just short of a 100 tick move in a relatively short space of time. Market turned back over, and that was pretty much the opportunity.